What about Silicon Valley Bank then? Because that seemed to be swift action. But I remember the sentiment of like normal investors was like, let them burn. Because they were like, the VCs, like people thought it's their own fault. Why are they getting bailed out and I didn't in the '08 crash,
Yeah, so Silicon Valley Bank is a great example of a few things. So, I mean, one is speed of financial crises these days, because the run on it was digital. And then immediately, within days, other mid-sized banks will be affected. Now, when we say mid-sized banks, Silicon Valley Bank was the second biggest bank failure in U.S. history. The only one that was bigger was Washington Mutual during the 2008 banking crash. And so when we say mid-size, I think we just bear in mind these are big banks. They're just not, and this is a point of regulation, they weren't regulated as systemically important financial institutions. It's not as big as a JP Morgan. But here's a lesson from history that I think probably should have been heeded a bit more, which is I write about the 1980 savings and loan crisis. So savings and loans in the United States are like banking associations here. They're just local, banks. They lend mortgages and things. If enough of them fail, it can be a systemic crisis. So many of them failed in the 1980s, one in each U.S. state at least. It was the worst financial crisis since the Great Depression. So that is the reason why the U.S. Treasury, Janet Yellen, who used to be the Fed governor, stepped in really quickly, because if enough mid-sized banks fail, it can still trigger a systemic crisis the way that you saw in the 1980s. So what she did was to essentially guarantee the deposits over the deposit limit. So the deposit limit in the United States is pretty generous.
$250K.
Which is more generous than in Europe. But she went basically just guaranteed all the deposits, and that's where some of the, as you say, the unhappiness came from. And I think it creates what's called moral hazard, where if banks think they'll be bailed out, then they could act in more risky ways. So, history will judge the effectiveness of that, but the immediate impact was to stem the crisis. And then they found buyers very quickly, actually, to buy pieces of it. But there's lots of lessons there, including regulation. So I just mentioned this is the second biggest bank failure in U.S. history, but because it was a regional bank, it wasn't regulated to the same extent as the JP Morgans, the big banks. And so that's a lesson that if you look back to the 1980s, probably should have been heeded a bit more, which is why I make that point, which is just because they're regional or mid-size, it doesn't mean they should be more lightly regulated if they still have this risk of being systemic.
It's like taking a domino out because the dominoes are falling and spreading, and you've kind of got to remove one to stop this collapsing chain. This point that you said there about viable businesses, there's a quote where you say, don't pretend that we have policies that can prevent a crisis, but instead support viable businesses in times of a crisis. But these banks, some of them don't seem viable, or in Japan, they supported ghost companies for years. So is the financial services industry protected from that sentence, from being viable, and they just get bailed out because they're banks?
So it's a really interesting debate as to, could you ever resolve the dilemma around too big to fail? I don't think you can.
That was a clip from a recent conversation we had with Linda Yu about financial crashes. If you want to see the full episode, then just click here.